Does the last one win too? All right. Okay, give us just 1 second here. Serge, be sure to click the mic icon in the bottom left. If you put your mouse over it, you can click on a little wheel to set up your microphone.
Okay, guys, can you hear me? Test 1, 2, 3. Perfect. Perfect. Morgan, should I just get started?
Yep, you're good to go. Go ahead.
Excellent. Thank you very much. Well, thank you, Morgan, for having me on again today. You're right. It's been about 4 or 5 months. I think it was February or something like that. I remember it was really cold outside. Thank everyone for tuning in on a Saturday. I know there's probably better things to do, or some at the margin more fun things, or at least sunnier things to do outside today, depending on where you are. I guess I'm just going to get started right here. I'm assuming I have about 40 minutes or so. I think that's more or less it, and we'll try to squeeze it in even a little bit quicker than that. Topic today is capturing investor emotions on the charts. So really what I'm trying to focus on is a technical analysis of the market, or my strategy in the market from a technical point of view, but very much focusing on emotions. And there's a lot of ways of doing this through some interesting variations of quite basic technical analysis tools. My name is Serge Berger, as Morgan said. I'm a trader, been a trader for professional trader for about 14 years. I now manage money managed accounts for my clients, and I'm also the founder of StudyTrader.com, where I offer things like daily trade alert products and swing trading course and a chat room and things like that. Quick disclaimer: I'm gonna just keep this up for a second, just just to make sure we're kind of covered. I have to always show these things, sort of saying that investments always have risk with them and things like that. Okay, let's go through the agenda quickly before we get started. First, we can talk about spotting emotions on charts. Like I said, really that's the topic today, just kind of giving you a quick overview of what does that actually mean. I think a lot of people, when they look at technical analysis and look at the markets, they forget sometimes that really what it's all about is perception of value and emotions on the part of investors and traders. And that can be algorithms as well, although those don't have any emotions, but they are at some point driven by some sort of person who input the algorithm. And then we talk about candlesticks, which is really what I'm going to be using as a tool to describe how to spot emotions, what they are, why I use them, and why I think it's a good idea to use them just at least as part of an analysis methodology. Then we're going to look at chart formations of emotion. In other words, what kind of formations on charts, price action tells us that there's emotion involved in the market that we can take advantage of. And as a fourth point, we're going to talk about areas of confluence, which is really where multiple indicators that I use come together and sort of allow us an opportunity to really pounce on the emotions with an even better rate of probability. And last, but certainly not least, we can talk about how emotions can, and the certain types of formations can really give us a very defined stops, predetermined already before we even get into the trade. That's the agenda. Important note, just quickly, when I talk about my methodology, take candlesticks and other things, it's a very big area of the market, so to speak, and by all means, I'm not talking about an all an all-inclusive thing here. This is just what I use, and this shouldn't be some sort of proxy to everything that regards candlesticks and other types of things I'm talking about today. There's tons of ways of using candlesticks, and this is just part of my strategy. Okay, first let me just quickly go through. I always like to show this slide for a little bit of perspective why swing trading, and I will say that you can use these types of setups that I'm talking about, that how to spot emotions also in an intraday time frame, by all means. I'm just going to quickly go on the basis of swing trading, which is really my core focus for the money I'm managing, also for the trade alerts and the other things that I do. Swing trading, by my definition, is not too hectic and not too boring. I like to use swing trading because I think a lot of people, when they start trading, view it as more of an entertainment than business, and that's not to be critical of anyone. That's quite normal. Swing trading, and I'll go. What we're talking about here is 2 days to 4 weeks. Again, one could use these strategies and on how to detect emotion intraday as well. Again, this is just my time frame of 2 days to 4 weeks, and it's really a sweet spot. So if you think about it, if you have a time frame between 2 days and 4 weeks, that's too long for day traders by definition, because they have to trade within a day, open and close. But it's also too short for most institutional investors, because their time frames are certainly at least mostly a few months at least. So you end up sort of dealing with a time frame that doesn't have very crowded trades. At the same time, there's plethora setups every month, so there's a lot of opportunities that come along all the time. And as I'll talk about a little bit later, clearly defined stops and profit targets are really a very important part of my strategies, because I feel that if you are going to trade, it's important to predetermine the profit and stop targets before you get into a trade, as opposed to making them up as you go. And that's the swing trading and the tools I'm about to go through allow us to do so. Okay, that's as far as swing trading goes. I'm going to start off with a quick quote from Henry Cotton. Henry Cotton was an English golf pro, I believe, and then many years ago, and I think from what I read, he won a few British Opens. So his quote was, "Missing a short putt does not mean you have to hit your next drive out of bounds." If you're a golfer, or you've done any sort of sports, or even certain hobbies where it's a little bit more competitive, you will note that spotting emotions from your opponent sometimes is a little bit difficult to do. If they're good at it, say in tennis or in golf, you have to really know the game to understand when the emotions come. In this case, if you're a golfer, you understand missing a short putt's frustrating. So on the next hole, you'll likely want to come up with a little bit of revenge or something, and you'll try to smack your drive really hard, and it may go out of bounds. So if I'm the playing partner of this person who just missed a short putt, I may not have seen the emotion in him on that short putt, because he may have sucked it up, tapped in eventually, and walked off the green. It wasn't until the next hole that I really myself, and that really gives me an opportunity, if I'm playing match play in this case, or if you're a tennis player, it's the same analogy. In the markets, it's very similar. A lot of people, again, look at the markets and think, and especially if you're a technical trader, they tend to get all wrapped up in too much of the details of technical analysis, and tend to forget that really this is a game between human beings, and obviously machines as well. But at the end of the day, even behind those machines, there are some human beings. So there are ways for us to be able to detect what the emotions in the markets are, and that's really what I want to show you today. So just like in sports, it's certainly possible to detect emotions of investors on charts, and by so doing, taking advantage of those moments. So let's start with one quick chart, and as Morgan said, I'm going around the PowerPoint presentation. So if you are a somewhat seasoned person in technical analysis, you will see that there are certainly several spots on here where you could say that there is emotion in the market. But for those that follow candlesticks and certain trading ranges, they will note that the two very obvious areas of emotions came in here. And if you can't see this in too much detail on the charts on your screen right now, I'm going to go through some even closer up charts in just a minute. But here's an obvious area of emotion. The stock had been trending down for a couple months. It rallied on this given day here, tried to rally past the recent high, failed miserably, and continued to fall lower. In fact, the stock dropped a total of 4 days quite sharply down to this day, couldn't push lower anymore, consolidated sideways for 2 days until it came in the next day. Two spots where we really could detect emotion quite obviously if we knew what to look for, and that's the key here. But if you know what to look for, and I'm going to go over some of these things here today, it's very possible to not necessarily pick the top or the bottom of a trend, but to get close enough to be able to pick off a few percent off, at least in an immediate term, top or bottom of a range or of a swing. Next slide. I think spotting motions. I'm going to go through some of the basics of candlesticks. For some of you, this may be a little bit too basic, but if you stay with me, you'll see I'm trying to go through candlesticks today, not so much as a technical analysis tool, but more what does it tell us about investor emotion. And again, like I said before, and I think it's the third time I'm saying this now, it's important to understand that the stock market and you know, futures markets and commodity markets and bond markets, which is where I cut my teeth at the beginning of my career, it really is all about emotions, or at least a very big part of it is. So candlesticks, just simply another way to use to look at price action, intraday, daily, weekly, monthly charts, regular chart environment, nothing beyond that. It's very similar to bar charts in some extent, but yet it's a lot more powerful. Originally, if you want to go through a little bit of history class, dates back to the ages, and you know, 18th century is when this all started. So from that point of view, you have an analysis tool that has been working for a long time, and many people, many successful traders have used this tool to detect emotions, not necessarily price action directly, but indirectly. And again, to me, that's a very powerful way of understanding the markets. It's very visual, the entire process, depicting emotions. That's the beauty of candlesticks. It's I think something like 60% of people are, was it right-brained, and they do the learning visually. So it really helps most people to have this sort of tool. Just quickly giving you an idea of what a candlestick chart looks like versus a line chart. On the right-hand side, I have a candlestick chart, left-hand side, a line chart, and you can see, I think quite obviously, there's a lot more stuff happening here in the chart on the right-hand side. It may seem a little choppier, but you also have a lot more turning points that are visually more obvious than you have here in the line chart. If you want to talk about an individual candlestick, what does it look like? you have two types of candlestick essentially. You have one that happens in an up or down day or week or month, and one that happens on an up day. So let's take the first candlestick here. You have the body of the candlestick. The stock came into this day, and I'm going to use daily analysis here as opposed to weekly or monthly. Stock opened here, closed the day down here, but intraday had a range that extended into these shadows, and I tend to refer to them as legs. People call them shadows and other things, but these legs here represent the rest of the trading range of the day. So what you note here in this case, the stock opened here, closed here, but the trading range was quite a bit longer. So both extremes of the trading range were rejected at the end of the day. Flip side is the day that opened low and closed high. Opened here, closed here, had a trading range that extended beyond the eventual closing price, but also had a push below the open price at some point during that day. So that's just the very basics of what a candlestick looks like. Quickly just go back into why using candlesticks. Just much more visual than a bar or a line chart, and I think that's really the first reason. It displays price action, investor sentiment, psychology, and really, and I think this is the key takeaway, is the footprints. What we're really seeing is the footprints of investors, and that's something that is not so easily detected in certainly line charts, bar charts, and even many combinations of other types of tools together. Footprints, like I said, they can only otherwise be detected through a series of indicators. In other words, to me, it's almost sort of a shortcut. As a trader, I can tell you, over the past 14 years of doing this, the quantitative analytic power behind, analytical power behind their at their disposal, and I feel like a lot of times it's almost too much. I come from the school of thinking that, keep it simple. You can overdo it, and if I use a candlestick bar, most of the time I can do just as well, maybe even better than some guy who has crazy amounts of computers at his disposal and algorithms and all sorts of stuff. That's at least what I've learned over the past 14 years or so. More on why I use candlestick. Formations are key. So, and I'll show you this in just one second. You can look at a candlestick, but a lot of times it's not just one candlestick that's important. It's a series of them together that forms a formation of at least a few days or so that gives us an idea of what investor sentiment is doing. Decision making without emotions is a huge part of candlesticks. As you'll see, both stops and price targets, but more importantly, stops can be predetermined the way I use candlesticks in detecting emotions in the market. Defined risk, like I said, clear stops, and that brings us to the three candlestick formations that I like to focus on primarily. I do use others as well, but the three candlestick formations I like to really focus on every morning when I get up and I run my scans and I run through everything that I do are the following. I like to look at shooting stars, and I'll describe each one of these in just a minute and give you examples. Shooting star happens at the top of a trend. It means bulls are running out of steam. Hammer is the flip side of that, at bottom of a trend. And the third one is the outside day, engulfing candles, which is either bullish or bearish depending on where on the chart it happens. Engulfing candles, if they happen at the top of a trend, are bearish. At the bottom of a trend, they are bullish, at least for a trade. And let me actually quickly go back to this, and I think that I just, with one eye, I'm watching the chat stream. I think let me mention this. When I talk about using candlesticks to detect emotion and eventually get into trades, my goal is not the bottom pick or the top to pick the extremes of a trend. All I'm trying to do is capture a certain reversal, sometimes a reversion to the mean, or a breakout in the middle of a swing. I'm not trying to capture and be greedy the entire rally or the entire sell-off. I'm just trying to capture a certain point. My sweet spot in profits is somewhere between 3 and 7% per trade. Beyond that, I'm not very interested, although I can always stay in the trade if I want to and trail the stop. But more or less, I'm just trying to capture what I consider the highest probability point of the trade by understanding what talk about the hammer. The hammer really happens at the bottom of a swing. I'll give you an example in just 1 second. The bottom of imagine you're in a swing to the downside with drop, whatever, 5–10%. One day you come in and you see this candle at the end of the day. Okay, whether the body has to be small, whether it's filled or unfilled, doesn't really matter. The point is, stock came in the day, tried to push lower, failed miserably, closed back up here. What is it telling us? Investors, bulls got nervous. Bears got nervous, showing emotions. The bulls took over, at least for that day. So correctly trading off a hammer, however, needs a price confirmation day. Okay. In other words, we see the candle I just showed you. You need the next day it needs to give you a confirmation in the same direction of where into the upside. In other words, you have to wait for follow-through strength. That day in and of itself isn't enough to really give you, in my opinion, a good enough edge, because you want to see if the investors really gave up that day, if the bears really gave up on that day. Again, it can mark the beginning of the swing or the end of a well, it can mark the beginning of a swing. I'm sorry. But again, my point isn't to go, and I noticed a question there. My point isn't to go against the trend. My point is to understand that investor got nervous. In this case, the bears got nervous, and I think there's a pretty good chance of the market rallying 3, 5, 7%, and that's the point I'm trying to capture. These types of even these types of formations in the broader direction of the market, but again, I'm just trying to pick off a few percent, not trying to be greedy. And the example I'm going to give you here, first example, is in the IWM, which is Russell 2000 ETF, happened in April 2013. Let me get to the charts. And if you can't see the chart clearly enough, please please shout out. In fact, this is the wrong chart. Let's go over here. And IWM, Russell 2000, ETF, April 2013, not very long ago. Right here. Let me zoom in. Sorry, it takes just a second to zoom into these charts. And what you're seeing again, we are basically trading in this case also in the broader direction of the trend. We had a bit of a correction, if you want to call it that, that happened in late March. Stock fell, and let's zoom in really closely and look what happened. We have a hammer candle that showed up here. Lots of volatility, actually, some pretty long bars. So investor emotion was happening, but there was no, from a candlestick point of view, no real advantage, no real edge to be gained on any of these candles until you came into this little range. Again, we're trading in an up market still, but the Russell 2000 corrected to the downside. At some point, refused to go lower. In fact, if you look at the charts on April 17th, the market found a low, spent a couple of days rejecting any further dip below the 89.25 level on the IWM. a real, in my opinion, a real hammer candle didn't show up until this day, which was the 22nd of April of this year, and that to me was the real emotion that came into the market that day when bears really tried it one more time. They break below this area, couldn't. Bulls took over. Not only closed rallied strongly intraday, but closed very near the high of the trading day range. Arguably, one could enter the trade here on the very next day, or even at the end of that day. Personally, again, this is just my trading rules, but I feel more comfortable seeing confirmation buying, not necessarily the next day, although that's nice, but at some point over the next 2 to 5 trading days after that, to really make sure this wasn't just a one-time event. And you know, the rest is history. So that's one, I think, very good example. Next example is GE. This is October 2011. Let me flip back to that. October 2011. I have to go back a little bit further, and I'm not cherry picking here, by the way. Before, when I came up with these charts, I felt like I was going back a little bit far for an example of a good hammer. But it's just some of the trades that I actually done as opposed to just picking something off a chart. So look here, GE trading to the downside. This is one where this wasn't necessarily in or against the direction of the trend. It was quite choppy. But what we had is we did have longer-term support, which in this case, I'll talk about this in a minute. But what we really had is a very choppy trading area from August all the way through the end of September. This was a very choppy period in the broader market. You can look it up. What happens? We come in on this day, the 4th of October. The bears give it all, come down, push the stock way below the trading range on that day, but just simply couldn't get it done. Emotion takes over. The bears capitulate. Bulls take over. And look what happens. You have a very nice reversal day. Arguably not a textbook hammer, but I can tell you what's important on these reversal days is the long tail. The long tail, or the long shadow, some refer to, is, in my opinion, a lot more important than the size of the body between the open and the closing price. Next day, stock came in, gapped up, and rallied higher, and the rest is history. Again, not trying to be greedy, just trying to take a few percent out. Although eventually, and this is important in a greater context, if you have a longer-term time frame, this did mark a bottom. Remember, we didn't. If you look past a little bit, then in the mid-November, about a month and a half later, the stock never dropped below that day's closing price, which also happened to be lateral support if you go back a little bit further. So that's the second example of a hammer. Let's move on to the next. Formation. A few questions. I'm just going to pick a couple of questions. Is there any way to scan for hammers and candles engulf? Yes, Dennis. There are ways. That's going to depend on whatever software you use, or broker platform or something like that. I don't want to pitch any given name here, but I'm sure if you just go out there and look at some of the charting tools, you'll find something. Let's talk about the engulfing candle, and I'll be very honest with you. Engulfing candles to me are when I see a very visual one, I see more than anywhere else. I see investors are getting very emotional on that given day, week, or month, whatever the time frame of that candle is. Bullish candle, a bullish engulfing candle comes at the bottom of a downtrend or somewhere in the middle of a downtrend potentially. That's not really relevant here. Opens below the previous day, rallies very strongly, and closes above the previous day's open to close trading range, so fully engulfs at least the previous day's body. It doesn't have to necessarily fully engulf the entire trading range of the previous day, but it has to be at least fully engulfing the trading range. Same thing, or the flip side is the bearish engulfing, where you have a market going up at least for some point. Gap up the next day, but falls horribly. Just bulls totally give up. Emotions come in, bears take over, and we close well below the previous day's opening price. That's the engulfing candle. Let me give you some examples here. Again, it can mark the beginning or the end of a swing depending on where it happens, or the continuation of a swing. And that's, I don't think I'll have time to go through that today, but that's an important part of my strategies. Not just trying to pick off the first 2 to 5 or 7% of a swing, but also the middle part of a swing. When you have breakouts and you see these very visual candles, that's a lot of emotion that you can depict through candles in there. When bears or bulls capitulate, depending on which way the market breaks. We talked about this. Confirmation, I like to see a confirmation candle, just like I just talked about on the hammer, follow through buying or selling in whatever direction the market just came from. TJ Pacman, do these work intraday? Yes, they absolutely work intraday. In fact, I do a lot of futures trading of the S&P futures and other things, and I use them intraday every single day, except Fridays in the summer. I don't like to trade summer Fridays. Examples: Yum Brands. Let me give you this example quickly. I have to speed up a little bit. I'm seeing that we only have about 15 minutes left. And again, folks, just keep in mind, you know, I think if I read a lot of technical analysis books, and I think there's a lot of good ones out there, and listen to a lot of other traders, whether it's TV or anywhere else, a lot of the focus is. Let me see here. Yum Brands, May 2012. That's not too far back. Here we are. Okay. Yum Brands, by the way, a trading stock near and dear to my heart. It gives us a lot of great opportunities because it does have a lot of investor emotion all the time. So look at this. We have a market trending to the upside. Okay. We start to see some emotion happening here. At some point, you see it. You see the stock tries to continue to push higher. We have a lot of choppy trading days here for a couple of weeks until we come in one day. We try to gap up one more time, try to break. Somehow the bulls give it one more shot, open the market higher that day, try to push it up, fail miserably, capitulate, and break lower. Not only engulfing. Let me zoom in closer. I think this is very important. Not only engulfing just the previous day's open to close trading range, or the previous day's body, but the next whatever that is, 5-10 trading days. Huge emotions in the market. People just literally gave up that day. The bulls really gave up. The very next day, I see confirmation selling. Yes, the market did bounce back on the third day, but eventually you can see the market certainly turned lower. And again, making anywhere between 3 and 7% here would have been a piece of cake within a time frame of a couple of weeks. Tony, you're asking why is the example 2012 or if you listened just a minute ago, the first example I gave you was an IWM in April. I'm not trying to a few trades and put up the charts. It's not really a matter of cherry picking. Nikki's asking, where do I get in this trade? I get in at the close of the follow through confirmation day, which is in this case this day here, which is the 4th of May, $71.15. Yes, the market bounced back the next day, but as you can see, what happened thereafter speaks for itself. The next example is also in Yum Brands, and actually the reason I picked Yum Brands is because it has a lot of these examples, and I do trade this stock quite a bit. Stop placement, guys. I'm going to talk about stop placements in just a minute. It's on the agenda. Very simple. 2012 in July, we got a great outside day. So remember, if you got in here, you made a few percent. At some point, you get out. Whatever your price target was, whatever you feel comfortable with. At some point, the market market comes back here into this, in this case, the support level is somewhere around 60, 61.5. We come in here, we see a lot of candles, hammer type of candles, none of them very good, to be honest with you, very choppy trading environments. And on this very day here, on the 12th of July, you get a very big outside day, fully engulfing the previous day's trading range, and all happening within the bottoming range of these bullish candles that happened, but never really fully materialized. And the very next day we get confirmation buying. Yes, the market pulled back a little bit, but eventually it took off quite nicely here, and we'll certainly be able to make a few percent on that trade. Let's move on to the shooting star candle. And again, keep in mind, I'm showing all this not within the context of just looking at this from the point of technical analysis, but really understanding that investor emotions is behind this. And that's, I really think it's just once I started to understand that this is about investor emotion as opposed to just a chart with a bunch of colorful sticks, to me, that really gave off a signal. Nikki, yes, I get in the trade at the end of the confirmation day. Okay, shooting stars is the third type of candlestick I look for, and again here, it's not just that day that's important, but it's usually leading up to that day and following, and the following days that are telling, and mostly the days leading up to the shooting star candle, you already start to detect investors getting emotional. Shooting star, the opposite of the hammer, happens at the top of a trend. You see the bulls trying to push the stock higher, intraday, fail miserably, bears take over, and the stock closed at the very bottom of the trading range, of that day's trading range. So here's a shooting star, powerful candlestick signal, bulls running out of steam. It is a very powerful signal. I would say out of the three formations that I'm talking about here today, this one is probably the one I would be most hesitant to use in a strong uptrend. So if you're looking to trade against the grain, and that's not my recommendation, but trades do set up, I would at least do it with a shooting star candle. Confirmation, like I said, I don't think the confirmation is needed, not always needed, depends on how strong, how long the tail is on the shooting star, and I'm going to show you this in just a second. The example here is Netflix back in February 2012. Again, I'm not cherry picking whoever asked before. Just one of the more memorable trades that I did with a shooting star, so I wanted to give you this example. If you remember, Netflix was and again is a big cult stock, certainly back in 2011, and has been for a good part or the entire part this year. February 2012, so that's not too far, that's just here. Okay. This is actually an example I'm going to show you later when I talk about confluence zones in just a minute. You had a stock here that was moving up very strongly. You start coming into this area here where you already had one shooting star happening on this day, which was the 30th of January. Conceivably, one could have gotten into that trade here, and if you realize where I put these stops, you wouldn't have lost. You would have remained in that trade. However, the more patient trader would have waited for some of this chop to resolve itself a little bit better, and noticed that there was a very nice shooting star candle above the previous shooting star candle that came in just a few days later on the 7th of February. You had confirmation selling the next day. If you would have wanted to wait for this trading range to break, you could have waited another couple of weeks or so, all within the context of understanding that this shooting star candle here was very powerful. Bulls tried to push past the intraday level of this previous shooting star one more time, didn't work, failed miserably, and again, the rest is history. A lot of people are asking again, where do I put my stops? I'm going to talk about stops in just a second, folks, but just to give you an idea, the stops are always at the very top of the signaling candles trading range on that day. So in this case here, the stop, if you would have gotten in this candle, is at the very top here on the 7th of February 2012, which was somewhere around $133.35 or 40 cents or something like that. Okay, I hope this makes sense, and I hope you're starting to see that really investor emotion can be detected, especially using candlesticks, but more importantly, if you understand that candlesticks are telling us a story. They're telling us a story of investor emotion, and that's just incredibly powerful. Candlesticks and confluence zones. I'm going to flip through this very quickly. Essentially, what I look for when I use these candlesticks, I don't just look for the candlestick. I also consider other factors, and to increase the probability or decrease the probability that day's investor emotion was nothing more than an algorithm freaking out or one big investor getting out, I like to see other types of confirmation, also using technical analysis tools. Some of the things I use are moving averages, Fibonacci retracements, overbought, oversold momentum, all in conjunction with the signaling candlestick or the signaling investor sentiment that we got on that day. First example is Honeywell, November 2012. Let me show you this chart here quickly. And what I now did is I'm using a very simple setup of having a stochastic oscillator at the bottom. It's a slow stochastic oscillator, I believe. For those of you that want to know, the 200-day moving average is in red, the 100-day is in blue, and the 50-day is in yellow. So that happened to also be the bottom or the beginning of this monster rally we're still having in the broader market, but it also was a good spot for Honeywell. So look at this, the market was tapering off here into the bottom, into the summer 2012, rallied very strongly here with the rest of the market. Honeywell did, and at some point lost momentum in the beginning of November, pulled back to its 200-day moving average, gave us a very clear hammer candle, okay? From a momentum point of view, the stock was way oversold. If you consider Fibonacci retracement, and again, I don't want to go into a discussion of Fibonacci. I think that's something everyone can read up. You will note that it was about a 50% retracement that the stock did at this point. So retraced 50% of this entire rally up off the summer lows. Big hammer right at the 200-day and the 100-day moving average, more or less. Oversold momentum. Then very next day, the stock gapped up. You zoom in even closer. Gapped up, and there you had an entry at the very end of that closing day, and of course the rest is history. So investor emotion was very clearly visible on this day when the bears tried to push the stock below this very important confluence area where multiple technical places came together. The bears failed miserably. Bulls took over, even though the day closed lower. The stock managed to close well off the lows, and the next day gapped higher and ran. And the second example is F5 Networks, and I will actually give you there's an actual current setup in hesitant on taking trades against the grain, but the first example was September 2012, and if I could find that here, oh, right here, okay. Very similar, except it's just to the downside in this case. The stock dropped quite heavily from May 2012 down to the summer lows, rallied back about, I think this was just about 50% from a Fibonacci point of view, into the 200-day moving average. Shooting star candle arrived on the 18th of September. A few days later, we got a confirmation selling day, which I consider a day where the stock closes below the low of the signaling candle. Okay, momentum was overbought, and boom, you had an entry. Stock went lower. You made a few percent, 2 to 5, 3 to 6, 7% is my target usually, and that's all she wrote. Again, Nikki, where I would have gotten in, it's the confirmation candle doesn't have to come the very next day. Sometimes it takes a few days to come in. Investor emotion was pretty clear on this day here, on the 18th of September. I would have gotten in this case. This is a somewhat rare case where it took more than a couple days for a signal to come in, but it was very strong. It came in on the 26th of September when the stock closed below the low of the signaling candle on the 18th of September, right here. The price was somewhere near 105 on a daily closing basis. Okay, and I know I only have a few seconds left, so let me just quickly flip through and talk about stops. Okay, to answer a lot of people's questions, let me flip back to a plain white chart. The stop in the current example, actually, in F5 networks, is here. We have a huge shooting star candle just last week or 2 weeks ago, I believe. I think at the 200-day moving average, we haven't yet had any confirmation selling, so it's not yet a valid setup in my opinion. But that's one hell of a shooting star candle. Once we see follow-through selling, I personally will be interested in taking this trade. We haven't yet had that. The stop here, as with all the signaling candles I said, are at the top of the signaling candling. In this case, about 92.50 or 92.70, I think it is. If it's an outside day, it's also at the very top of the signaling candles, or the very bottom if it's a bullish setup of the signaling candles, trading range. And that's all I had. I think, Morgan, I don't know if you could run through the special that we had. I didn't quite get the memo on that. But I will show you quickly just my contact information so you have it. That's my name, that's my email address, my Twitter handle, and it was a pleasure being here. Thank you very much for having me. I hope it made sense. And have a great rest of the weekend.
All right, good deal. Thank you, Serge. We really appreciate you being here today. And again, I can tell you, I actually subscribe to Serge's service monthly. It's a monthly service. He sends out trade ideas. And I think one of the more valuable things, even than some of the trade ideas, is the market analysis that he shares. But basically, what the guys at Market 5 put together for today for the Trading Pub members, it's a 1 month of Serge's Steady Trader for $20 basically. I think it's like $20.95. It's Serge's best high probability trade setups that are emailed to you the second he enters the trade, full transparency of the entries and exits, full access to Serge via Q&A, and then education on powerful setups in the market. So it is, and it should list on the page. Let me see, I can answer that question for you.